Here is something most people never realize about their taxes. The IRS has built legal ways to reduce your tax bill directly into the system. Not loopholes, not gray areas. Actual, documented, IRS-approved strategies that are available to anyone, regardless of income, regardless of how much you invest, regardless of whether you have an accountant or not. The reason most people don't use them is not that they are complicated. It is that nobody ever explained them. Think about this for a moment. Taxes are almost certainly your largest annual expense. Most households pay more in taxes than they spend on housing, food, and transportation combined. And yet most people spend more time choosing what to eat for dinner than they spend thinking about legal ways to reduce that bill. A married couple earning $120,000 combined, using just 2 of the 5 strategies in this video, could reduce their federal tax bill by approximately $12,000 this year alone. That is not a projection from some financial guru. That is a calculation based on 2026 IRS limits published by the United States government. This video covers 5 strategies. You almost certainly are not using all of them. By the end, you will know exactly which ones apply to you. Everything in this video is legal, documented, and available to ordinary earners in the United States right now in 2026. We are going to cover exactly what each strategy is, who qualifies, how much it saves, and how to actually start using it. As always, this is educational content, not personalized tax advice. For your specific situation, work with a qualified tax professional. But understanding these strategies before that conversation will save you money regardless. This is wealth clarity. Let's get into it. The first strategy is the one most people use partially but almost nobody uses fully. Your 401k contribution reduces your taxable income dollar for dollar. Every dollar you put into a traditional 401k is a dollar. The IRS does not tax this year. It is the most straightforward tax reduction available to any employed American. For 2026, the employee contribution limit is $24,500 if you are under 50. If you are 50 or older, you can add an $8,000 catch-up contribution for a total of $32,500. And if you are between 60 and 63 years old, there is a new enhanced super catch-up contribution of $11,250, bringing your total potential contribution to $35,750. Here is the math that makes this real. If you earn $80,000 and contribute the maximum $24,500 to your 401k, your taxable income drops to $55,500. In the 22% federal tax bracket, that contribution alone saves you approximately $5,390 in federal taxes this year. Most people only contribute enough to get their employer match, which is smart because that is free money. But if your budget allows, every additional dollar above the match continues saving you roughly 22 cents in federal taxes for every dollar contributed. If your employer offers a Roth 401k option and you expect to be in a higher tax bracket in retirement, contribute there instead. You pay tax now, but every dollar of future growth is permanently tax-free. The second strategy is the one that shocks almost everyone who hears it for the first time. A health savings account, or HSA, is the only account in the entire United States tax code that gives you a triple tax advantage. Your contributions go in pre-tax, reducing your taxable income immediately. Your money grows inside the account completely tax-free. And your withdrawals for qualified medical expenses come out tax-free. Pre-tax in, tax-free growth, tax-free out. No other account in America offers all 3 simultaneously. For 2026, the contribution limits are $4,400 for individuals and $8,750 for families. There is also a $1,000 catch-up contribution if you are 55 or older. There is one eligibility requirement. You must be enrolled in a qualifying high-deductible health plan. If you are, and you are not already maximizing your HSA, you are leaving one of the best tax tools in the U.S. tax code completely unused. Here is the advanced strategy that almost nobody knows about. Instead of spending your HSA on medical bills as they come up, pay those bills out of pocket and let your HSA grow invested. The IRS has no deadline for reimbursement. which means you can save every medical receipt from now until retirement, let your HSA compound for decades, and then reimburse yourself tax-free at any point in the future. After age 65, you can also withdraw for any reason at ordinary income tax rates, exactly like a traditional IRA. But you keep the medical reimbursement option on top of that. A family maxing their HSA at $8,750 per year in the 22% tax bracket saves approximately $1,925 in federal taxes annually, plus whatever the invested balance grows to over time. The third strategy turns something that feels like bad news, a losing investment, into a genuine tax advantage. Tax loss harvesting is the practice of selling investments that have dropped in value to offset the tax you owe on investments that have gained in value. Here is how it works in plain language. Suppose you sell a stock for a $10,000 profit. You owe capital gains tax on that $10,000, either 15 or 20% if you held it for more than a year, depending on your income. That is a tax bill of $1,500 to $2,000. Now suppose you also have another investment that has lost $5,000 in value. If you sell that losing investment, you can use that $5,000 loss to offset $5,000 of your gains. Now, you only owe capital gains tax on $5,000 instead of $10,000, cutting your tax bill roughly in half. The IRS also allows you to deduct up to $3,000 of net investment losses against your ordinary income each year, your salary, your wages, if your losses exceed your gains. And any losses beyond $3,000 can be carried forward to future tax years indefinitely. The critical rule to be aware of is called the wash sale rule. If you sell an investment at a loss and buy the same or a substantially identical investment within 30 days before or after the sale, the IRS disallows the loss. The simple workaround is to buy a similar but not identical investment. For example, selling a Vanguard S&P 500 fund and immediately buying a Fidelity S&P 500 fund. You maintain your market exposure while still capturing the tax benefit. Many people think of tax loss harvesting as a year-end strategy. The better approach is to watch for opportunities throughout the year, especially during periods of market volatility like the ones we have seen in early 2026. The fourth strategy is not about reducing your taxes this year. It is about eliminating taxes on potentially hundreds of thousands of dollars of growth forever. A Roth IRA is a retirement account funded with money you have already paid tax on. Inside the account, every dollar of growth, dividends, capital gains, interest, is completely tax-free. When you withdraw in retirement, you pay zero tax on any of it. Zero. No matter how much the account has grown. The 2026 Roth IRA contribution limit is $7,000, or $8,000 if you are 50 or older. There are income phase-out limits. For 2026, single filers begin to phase out at $150,000 of modified adjusted gross income, and married filing jointly phase out begins at $236,000. If you earn more than those limits, the backdoor Roth IRA is the legal workaround used by high earners. You make a non-deductible contribution to a traditional IRA. Anyone can do this regardless of income, and then convert it to a Roth IRA shortly after. Because you made the contribution with after-tax money, there is little or no tax owed on the conversion. The result is money in a Roth IRA regardless of your income level. The power of this account grows dramatically over time. A $7,000 contribution this year, growing at 8% annually for 30 years, becomes $70,000, completely tax-free. Do that every year for 30 years, and the tax-free balance is well over $500,000. All of the growth, none of the tax. The fifth strategy is the one that surprises people most when they hear it. In the United States, if your taxable income falls below certain thresholds, your long-term capital gains tax rate is 0%, not low, zero. For 2026, the 0% long-term capital gains rate applies to single filers with taxable income up to approximately $47,025 and married couples filing jointly with taxable income up to approximately $94,050. Long-term capital gains are profits from selling investments you have held for more than 1 year. If your income falls within those thresholds, including after your 401k and HSA deductions have reduced your taxable income, you could sell appreciated investments and pay no federal tax on the profit whatsoever. This strategy is most powerful for people in transition years, a year you change jobs, take parental leave, go back to school, or retire early. In those lower income years, strategically realizing capital gains at the 0% rate is one of the most effective legal tax moves available. You reset your cost basis for those investments at no tax cost, which reduces the capital gains you would otherwise owe in future higher income years. Even outside of transition years, many middle-income households who max their 401k and HSA contributions find that their taxable income drops enough to bring some of their investment gains into the 0% bracket. It is worth calculating every single year. Here are the 5 strategies in order of impact for most people. Strategy 1. Maximize your 401k contributions. The 2026 limit is $24,500. Every dollar reduces your taxable income immediately. Strategy 2. Open and max an HSA if you are enrolled in a high-deductible health plan. The 2026 family limit is $8,750. Triple tax advantage, no income limits. Strategy 3. Practice tax loss harvesting throughout the year. Offset gains with losses, deduct up to $3,000 against ordinary income, carry forward the rest. Strategy 4. Contribute to a Roth IRA. Or use the backdoor Roth if your income exceeds the limit. $7,000 per year of tax-free compounding that accumulates into a permanently tax-free retirement asset. Strategy 5. Calculate your taxable income after deductions every year to check whether any of your capital gains fall into the 0% long-term rate bracket. In transition years especially, this is money you are leaving on the table. None of these strategies require a financial advisor to implement. They require a browser, a brokerage account, and the knowledge that they exist. Now you have that knowledge. What you do with it is up to you. If this video helped you see your tax bill differently, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. No jargon, just clarity. YouTube will show you exactly what to watch next right on your screen. I'll see you there.